Welcome and thank you for taking the time to join us this morning, or afternoon, or evening, depending on where and when you're watching this. My name is Marnus de Vries, and I'll be hosting this session today. I want to kick us off by making a statement. In transport, fuel isn't just a cost line, it's a strategic risk, and right now that risk is increasing. The reality is fuel is one of your highest costs, but one of the least understood, and that is where the risk sits. What's happening in the fuel markets right now, globally and locally, is changing the rules of the game. And if you don't understand those rules, you end up reacting to price instead of managing it. So today is really about one thing: getting you a clearer understanding of how the fuel market works, to what is driving these changes that we are currently seeing, and most importantly, what it means for you and your operation. Before we get going, just a couple of quick practical arrangements before we start off. After the presentation, we'll be opening up for a Q&A session. If you have any questions for Greg, our speaker today, please use the comments section below and send us those questions. Our team are standing by to collect those questions, and I will bring them through to Greg when we do Q&A. Now it's my privilege to introduce someone who brings a truly end-to-end perspective of the fuel industry, from supply to procurement to building businesses within it. Greg Sarchwittel started his career in the agricultural sector before joining Shell in 1994 as a fuel representative in the Lowveld. He later moved to Johannesburg, where he progressed to become National Sales Manager for transport markets, gaining deep insight into the supply side of the industry. In 1999, he joined Imperial Logistics, where he played a key role in establishing a centralized fuel procurement function, including fuel management systems and an independent on-road refueling network. He then became a founding member of Gulfstream Energies in 2008, where he experienced firsthand the challenges of building a greenfield wholesale fuel business in then a highly competitive environment. More recently, Greg has been involved with bulk fuel supply initiatives within the TFN group, focusing on developing a trading platform to connect suppliers and buyers and supporting new importers entering the market, and driving business development to expand the group's products and services. What makes Greg particularly valuable in a discussion like this is his understanding of the industry from all angles, as a supplier, as a customer, and entrepreneur. So you're not just getting theory today, you're getting real practical insight. Please join me in welcoming Greg Sarchwittel. Greg, over to you.
Marnus, thanks a lot, and thank you everyone for tuning in today. I think we truly are in an uncharted waters in terms of the situation we find ourselves in. I mean, if you look at my term in industry, I don't think we've ever seen the record prices remotely close to what we're looking at now. So what I'd like to do in my talk today is just start from an international perspective and just give you a bit of an understanding of what is happening out there, maybe some insights into the global oil trade. Then what I want to do is I just wanted to hone it down onto a more local level so that you can get a better feel of in terms of our current fuel environment, the regulations around it, so we can understand why what's happened internationally has impacted us so much locally. And then I think thirdly, just to discuss some considerations and look at some strategies that you as a fuel user or a transporter or however you're making use of fuel can look at to mitigate the risk that you're finding yourselves in the current environment. We've also been given some questions beforehand, which I've had a look at, and hopefully during the course of my presentation I'll be able to answer that. But please, if there are any things that at the end or during the presentation you want to know a bit more about, please feel free to let us have those questions, and I'll do my best to answer them given my knowledge and experience. I think it's important for us just to stand back and understand where we are in the world with regards to, can I say, the pecking order with energy. I mean, if you look at South Africa, the world consumption for fuel is sitting around about 500 billion litres per month. That is, considerable if you think about it. If you look at South Africa consumption, we're sitting really at around about 2 billion litres per month. So in total, we're looking at about 0.4% of the world's sort of monthly usage. Now, if you look at a ranking in terms of countries, that puts us at about 40th down the line of consumers, our peer countries being Algeria, Kazakhstan, Kuwait, and Chile. So, in South Africa, we politically or morally, we might consider ourselves to be international heavyweight, but in reality, when it comes to energy consumption in global terms, we are absolutely insignificant. Just to give you another perspective, the United States, the biggest economy in the world, uses just under 20% of petroleum, the total petroleum usage internationally. China is clocking in at just over 16%. What I want to touch on now is just the Straits of Hormuz, and obviously everyone's become an expert in terms of the Straits of Hormuz, so I certainly won't labor the point, but I think facts are that 20% or just over 20% of the world's petroleum moves through the straits, and it's definitely a choke point. If we break down that traffic today on a daily limit, you're talking at about 2.8 to 3.1, depending on the figures that you look at, billion liters of fuel a day. Now, given that South Africa uses just on 2 billion liters a month, I think that gives you a good perspective in what's going on there. I think what's important to note is not only what fuel is going through, but where that fuel is going. I mean, majority of it goes to the east. There's minimal impact on Europe in terms of being supplied out of that area, but it goes to all the big developing economies in the east, all of the countries that have got significant population centers. There's been a lot of work done in terms of mitigating the risk of that choke point. I mean, if you look at the Saudis, I think they've recognized this danger years ago, and what they've done is that they've built a pipeline from west to east or east to west, and what they're doing is diverting a lot of their production from the east-lying fields to the Red Sea. I mean, during this last month, we found over 300% increase in that traffic, and there you're looking at a 1.2 odd billion liters a day is being redirected to the Red Sea. Iran has given favored nation status to India and China to move product through the straits, but obviously that's really a drop in the ocean compared to what the traffic formerly was. UAE has developed a pipeline into Oman to take off the pressure, and also we found the International Energy Agency, which is a conglomerate of 32 companies that have hold about 1.2 billion barrels of strategic stock, recently released 400 million barrels of that stock, just to try and temper the impact of the shortage that we've seen. I think to gauge the impact visually, this chart tells you everything that you need to know. In a matter of 2 days, the straits went from moving 100 to 115 odd ships down to virtually nothing. Now, it's important to also understand the impact in the broader region that sort of this choke has had on vessel traffic. First of all, the Gulf countries that are producing, obviously this relates to loss of sales and has a serious impact on the economies. I think secondly, we've seen it and we're experiencing, living it through now, the impact of the global spike in prices, not only on crude and also finished product, but also it's important to note that all the manufacturing operations in the Gulf and the refineries have now reached their limits in terms of their storage capacities. So in essence, what has to happen is that all those plants need to throttle back, they need to close down because there's absolutely no place to put this product anymore. And obviously a refinery is a highly complex plant, and once you've shut it down, it takes a considerable time to get that fired up again. And obviously the concern is here when things do normalize, it's not a case of just turning on the taps immediately again. It's going to take a while for those refineries to fire up and get into full production. Also, we've had serious damage to some of the actual production facilities. LNG in particular, Qatar, who is the world's biggest producer of LNG, through missile and drone attacks, is down 17% on their production. And the estimate there is that it's going to take 3 to 5 years to repair the damage that has been done. I think closer to home, and I'll talk about it a little bit later when we talk about our local pricing mechanisms, but international freight and insurance costs for shipping has gone up. And that certainly is going to directly impact us in terms of the prices that we're going to see locally. I think the important thing to realize too, just relating to China and Iran, I think we'd be very naive to think that this war is just about nuclear weapons. I believe this is part of a much bigger geopolitical power play that's happening between the world superpower and the emerging power, USA and China. If you look at gas and petroleum products, it accounts for 60% of the world's energy. All right, and we all know energy drives an economy. If your energy is cheap, you've got economic growth and you've got competitiveness. It's important to realize that Iran's oil is sanctioned. 91% of that oil is going to China. And China, until recently, has been sourcing about 22% of its energy requirements from sanctioned nations, that being Iran, Venezuela, and Russia. And talk is that this has been at a discount of between $15 to $20 a barrel. So, we must realize that besides the impact it has on the world, this has got an even more serious impact on China, losing about 18% of their supply, crude supply at discounted rates. With it, they've got to cope with a spike in prices, crude prices. So they need to go out into the market to look for more expensive product to replenish that. And obviously that is also increased or added to the demand spike that we've seen. It's interesting to see what impact the last month has had on prices around the world. And if you look at that chart, it's just some indicative prices up until the 23rd of March. Of what's happened at pumps, retail pumps around the world. Looks as though sort of the Far East again, Philippines, Australia have had quite a big hit in terms of that. But I think in all these stats that you look at, we also need to understand that there are local factors that will come into play and potentially buffer this out. If we look at someone like Japan, who gets a lot of their crude and energy from the Gulf states, there's been hardly any movement. And really that comes down to strategic oil reserves being used to buffer out the increase, and obviously price regulation has also got a point to play here. However, I think we also need to understand that while we talk oil all the time, this conflict has had a much wider impact than just oil. If we go on to the next slide, something as simple or something as that we take for granted as fertilizer. If you look at the Gulf countries, 46% of the world's urea, nitrogen, comes from those refineries, which goes into commercial fertilizer. It's also interesting to see where this is going. I mean, a lot of that fertilizer is going to the countries to the east, China, India, Malaysia, which again have got big populations. So not only is our energy and our energy requirements to the world put at risk, but I think it goes much further than that, and things like food security start to play a role here too. Also, I'll take you through a bit of a refining process later, just to let you understand a bit more about that. But, things like plastics and industrial chemicals that are coming out of those Gulf nations have also been severely impacted. I mean, that goes to the heart of many industrial processes for industries across the world, be it from mining to manufacturing. So just to let you understand a bit more about sort of global oil trade and perspective, if we go to the next slide, we'll see that we talk about crude as if crude is a homogeneous product that, it's like water. Everyone talks about Brent prices and, everyone potentially thinks that crude is crude, and it can't be further from the truth. Crude is a very diverse product, and there's a huge spectrum of crude grades that we get in the world. And it goes all the way from what we term in the industry sweet crude through to sour crude and the heavy crudes. And really the distinguishing factor between the two is your density, or how heavy it is, and then your sulfur content. Now, from that chart, you'll see that different areas in the world produce different grades of crude, and those grades, or what they produce, is sent to specific areas around the world or specific countries. What we've seen, as we saw in the slide on where the product from Hormuz is going, is that the Gulf nations produce predominantly medium and heavy sour crudes, and that's predominantly going to, again, to the east, to the likes of India, Malaysia, China, all those countries. In fact, 72% of Saudi's production goes to India. So production and the supply of crude out of the Persian Gulf countries is particularly critical for India's energy security. To understand the significance of this, the global supplier and refiner balance, we just need to have a bit of a basic understanding in terms of the refinery process too, which I'll refer to you in the next slide. Now, refineries, for want of a better term, is just a supersized distillery. What you do is that you take superheated crude, convert it to a gaseous phase, and then you insert it into what we call a fractional distillation column. And as that gas cools down, your various components or your various products that you derive from crude start to condense or come out of the distillation column. The first to come out is your very heavy oils, your bitumens, your ship and your industrial oils. Next to come out is your fuels, your diesels and your kerosenes. Further up the chain, then you get your petrols, your gasolines. Then you get your naphthas, which is really your industrial petrochemicals that are used in chemical processes throughout the world. And then right at the top, you'll get your LNGs, your LPGs, your gases, which are also used for heating and in industrial applications. Now, it's taking the crudes, the different crude grades that I referred to previously. When you put them through a process like that, what you get is that you get different refining yields. It's also known as the cut of the barrel, and that really refers to the ratio of the different products that come out of there. So if you look at your light crudes, like Brent oil, right at the top there, you'll see your fraction of light products. In other words, your high-value products such as petrol, diesel, LPGs, that all comes out. The refining process that is used to refine it is pretty simple. So what we find is that refineries that are configured to refine sweet crudes, there's a lot of petrol and diesel that comes out of them. It's very relatively cheap, but because of that, your crude oil is generally the most expensive, which is why Brent oil falls into this category, why Brent is used as the indicator of oil prices. However, as you move down the chain to your heavier crudes, what you'll see is that the crude becomes cheaper, but your industrial process to actually extract what you need out of that crude becomes more and more sophisticated, and the various fractions of products that you get out of there. So your heavier sour crudes, what you'll find is that you get less fractions of your high value petrols and diesels and LPG, while you get a lot more of your lower cost or lower value products like bitumen. You'll recall in the previous slide that I did that the USA uses a lot of very, very heavy oil, which it gets predominantly from Canada and from Venezuela. But you'll see at the right hand the 1990 US production figures. While they are still using very heavy crudes, very sour crudes, you'll see that they're getting very, very good production, especially of the more valuable products out of that. And that's really comes down to the sophistication of the refineries that they use. They've got extremely sophisticated refineries. There's a lot of additional processes that they put that crude through, and they are able then to extract, a lot of more high-value products out of it. But it does come at a cost in terms of expenses. So it's important to know that your refineries are set up or linked to process specific grades of crude. If you go into the next slide, you will just see a diagrammatic representation of a typical refinery, what they would look in terms of their feedstocks. So you can see they are very specific in terms of what feedstocks they need to get into or to refine efficiently. So the question is often posed, why don't we just get, for South Africa, crude from Africa or crude from here, crude from there? And that's really what it amounts to is that we cannot just take crude from anywhere in the world and push it through the refinery and expect to get the results and the efficiencies that we are. The crude that goes into refinery is very specific to that refinery and needs to be sourced from a specific area in the world. And that really is the limitation that we see in terms of when you have an area like the Middle East, that we have a sudden dramatic cutoff of supply, is that all the refineries that are supplied out of there really haven't got too many other options in terms of where they go to source their crude from. All right. Why are we being impacted so badly in South Africa? Now, if you look at, it's a very interesting graph I had a look here. This is all indexed onto 2024 dollar values. And it just tracks what crudes have done in terms of political and economical upheavals since the oil crisis in the 70s. And as you can see, there are some significant spikes that have happened there. Significant shocks. We've gone through the 1970s oil crisis. Included in there are things like the two Gulf Wars, the Iran-Iraq War, the 2008 global financial crash, the COVID epidemic. So there have been some, but we have never seen the impact on particularly our country of those shocks as we've seen now. So no, while we can't negate the seriousness of this, I think we need to have a little bit closer look at the South African fuel industry and just understand the environment and the changes that's happened within the industry, and also our pricing regulations and how that has exacerbated the situation and why we're seeing the impact that we are at the moment. So what are these changes? I think the first significant change that's happened in South Africa over the last few years is our loss of refining capacity. We used to have 6 big refineries. We used to import crude, and for 5 of those 6, and we used to, or 4 of those 6, sorry, and we used to produce, and we were in a way insulated by those shocks. However, because of our loss of refining capacity, we've lost 3 major refineries, and I will just allude to that a bit later. But we are now a net importer of refined product, and that has exposed us to a lot of international risk with regards to supply and price movement. In the past, the oil majors used to dominate our industry, but recently what we've got global traders that have now started to move into the market, and particularly downstream. In recent years, we've had the likes of Trafigura moving in with Puma into the country's fuel environment. Glencore has taken over Caltex, running it now as Astron, and they've taken it a step further and got involved in refinery down in the Cape. And recently, we've got Vitol and Engen. So with regards to the environment and the players within it, it certainly has been a bit of a shake-up, and particularly when it comes into the way of doing business. So what's happened in recent times is that the way of doing business in the fuel industry has moved more into a trading type environment, and with that has come sort of changes to the rebates that we've seen available and the prices that we've seen available in the market. But obviously that has also got some implications with regards to product supply and risk. The contracts that we used to in the old days, the oil companies signed for 5 years, and you'd plot out your 5 years. Well, the new mode of doing business is with take or pay agreements and commitments. So certainly the ball game has certainly changed as far as that's concerned. What we've also had in recent times is the likes of Bergen and Vopak terminals coming into the country, and that basically has opened up the field for independent importers to have independent storage to bring it in. So that has also added another dimension to the fuel markets here, where everything used to be dictated to by the oil majors, as they had the refineries, they had the crude storage facilities, they had the storage facilities and the depot outlets for providing fuel to everyone. That has changed quite dramatically, and now we have got new kids on the block that have come in and have got access to the storage to be able to operate as oil majors, but in many cases at a fraction of the cost. What has also happened in the fuel market is the whole rise of the wholesaler channel. In the past, again, the oil companies, the majors, used to dictate or sort of, before reaching, every second little town used to have a depot, and they used to provide the fuel, whether it be to retail, commercial, farming, in all the areas. What we found in recent times is that the wholesale channel, really in the rural areas and in the commercial markets, has taken over from the fuel majors, and they are now servicing these markets. But the caveat here being is that the oil majors are still, from the bulk side, major suppliers to these independent wholesalers. And as history has taught us, and we've seen again this month, when supply is restricted, what happens is a lot of the major players then withdraw to their core markets, which is really their retail networks and their big blue chip customers, and wholesalers get left hanging. So, the knock-on effect of wholesalers not being able to access molecules, not be able to access stock, has a direct knock-on effect, not only to the commercial markets, but as we've seen, into the rural markets as well. Incidentally, I just yesterday saw a letter that had been written by Agri-SA and Agri-Biz to the Department of Energy, just asking them to have a relook at things like supply security into the rural areas, and sort of pricing into the rural areas, because especially for the rural community, this has become a major concern for them at that. I think if we just go to the next slide and just dig a bit deeper into our refining capacity, just to see what has happened, we'll see that we have had major refineries in the country that we have lost over the last few years. But incidentally, that's not only a South African phenomenon, that's sort of been prevalent across sub-Saharan Africa. So as things stand today, we only have 2 crude refineries and 1 coal refinery, which is basically a coal to liquid refinery, which is Sasol Secunda. And the implications of this are quite important. I mean, first of all, if you just talk about infrastructure and the loss of both crude and finished product storage, there's no buffer now in terms of excess capacity of stock being held that can be pushed into the system when there are supply shocks. We've also had the sale of our strategic fuel crude, which happened a few years ago under questionable circumstances. And so obviously at the moment is that we're running, in terms of our crude capacity and our crude buffer stock, pretty low. The other issue is that, being net importers of refined product, we have now moved from a situation where we could hold crude as buffer stock, which is relatively cheap when compared to a refined product. So for refined product to hold stock at that, I mean, obviously the value is a lot higher, so the financial implications of holding buffer stock become quite astronomical when you look at the numbers. Also, the loss of the refineries and the loss of storage capacity for refined product. Although we have got obviously the independents that I've talked about, the Vopax and the Bergens that have come in, still we are far behind what it used to be. And so what's happening now is that the country operates in a just-in-time mode with regards to fuel imports. So the product comes in and it needs to go out almost immediately. So the leeway for buffer stock being built up there is very, very narrow, very, very thin. So this all translates at the end of the day into increased supply volatility and increased price volatility. If we look at the next slide, it'll just give you an indication of how our dependency on crude has dropped over the last few years. Unfortunately, the latest reliable information that we could get was 2024, but clearly you can see the downward trend there. However, the next slide refers to the increase in imports on diesel, and there you can see over the last few years an exponential increase in terms of that. So obviously what's happening, it's very clear we're moving from a point where we've had buffer stock sitting in crude and production facilities into a more just-in-time scenario where that stuff, the margin for error becomes slimmer and slimmer. Next, if we go on to our pricing regime, I think there's a few things that we need to understand about our pricing regime, which is leading to the impacts that we've seen in the market. First of all, I think there's three important features that we need to recognize with regards to pricing in South Africa. The first is that our pricing for petroleum products is regulated. So there's a set of defined rules that need to be followed with regards to that. The second important thing is that we operate on what we term an M-1 pricing formula. So what does that mean? It means that the average pricing for this month becomes the set pricing or the wholesale list price for next month. So this effectively means that we are running 1 month behind what's happening in the real spot markets in the world. So, and that running behind leads to what we term under and over recoveries against the current set price, which I'll take you through a bit more in detail later so you can understand it a bit better. But the key feature here is obviously when you start importing product and you're running a month behind, sort of in terms of the pricing that you recoup from the market, you need to secure product today and within this month, and it takes about a month or so to move it into a market, but you've got no view in terms of what the pricing in the market's going to be at that time. So there's a lot of inherent risk that sits in terms of importing product, which we need to recognize. And I think the third important thing is just our monthly adjustments. You know, countries that work on spot pricing, on that the prices move on a regular basis, almost on a daily basis. But as soon as you move into a scenario where we're adjusting once a month, you know, what happens that during the month, the price change or the set price doesn't account for any movements in the international markets that is happening daily. And we've seen this particularly in terms of this month, where we've had shortages and then in a massive spike in terms of the pricing. Also important to recognize that we have got an offshore component to our fuel pricing and a local component. Now, that offshore component is what we term our basic fuel price, BFP, which you have heard the term, and that really is based on the pricing had on the day that you can get in spot markets and split 60% or 50% Mediterranean, 50% Arab Gulf, where the Arabian Gulf, where all the action is happening at the moment. This too, it's important to recognize that it's procured in US dollars per ton. So there's a US dollar component to it. Then what you'll do is that you'll move to our local pricing components, and this really comes down to all our industry costs with regards to storing the product and moving it out to customers and our depot infrastructure. And also then obviously the bugbear in everyone's life, the government taxes and levies. And this is all priced in rands. So there are three important price drivers when we look at pricing in our country. The first is obviously because we are sourcing product, refined product on international markets, what is the current spot price, you know, in the various locations that we look at indexing against? And that is done in US dollars per ton. Because it's priced in US dollars per ton, obviously the exchange rate at the time of purchase becomes pretty critical in terms of how that's going to translate to a price in rand terms. And then obviously we've got the imposts on the government side. Now, if we dig a little bit deeper into this, we can go on to the next slide, which basically takes us through the BFP components. What makes up the BFP? So you'll see a list starting with your international free on board prices at the bottom. Then you have things like your shipping, your freight charges, your insurance charges for that, your demurrage for ships standing unnecessarily, and that's how it gets built up into a landed cost on our shores. As of March, this cost was standing at R9.91, so just under 10 Rand from that. Now, it's important to note I've highlighted the bottom three components in red because in terms of what we're seeing currently, they are going to be pretty important drivers. Obviously, we've got the international prices, which we've seen have spiked, and that's why we've seen the prices do what they have. But then we come to our freight and insurance, our freight costs and our insurance costs for that shipping. Now, in terms of our price formulas that we work to in our pricing mechanism, those are they're generally pretty stable internationally, so those are really adjusted and looked at once a year. However, because of the situation in the Gulf, is that we have found both freight charges and insurance charges for the shippers has spiked and gone through the roof. So that spike is not accounted for in terms of the way the regulatory framework works in terms of determining what the price movement is going to be. So realistically, what we're going to find is that whoever is importing that product is going to have to make up for that somehow. It's not going to be made up in the price regulations or the deemed price movement, because that's not part of the calculation. So I think realistically what we will find is that the rebates that we've been experiencing over the last while, sitting in the rands plus, I think we can realistically expect those in the coming months to decrease quite dramatically. To what extent, I'm not sure. I'm sure we'll find out sort of as of tomorrow. But that's certainly something which I think we mustn't set our hearts on, that we're going to have the sort of rebates that we've been used to up until now. I think moving on to local costs, you'll see there that as I've said before, they are in South African rands. You've got your regulated government imposts, which are listed in red, which run at about R6.24 at the moment. And then you've got our industry costs. In terms of the regulatory costs, really there are two sets of costs which are changed every year. You've got your costs which are announced in the budget, which is around 21 cents a litre for diesel at the moment, and these are due to come in tomorrow. So to add insult to injury, yes, besides what we've seen in terms of the international markets, we're going to get an uptick in terms of our regulated charges as well. And then what you've got, the industry costs, which are normally amended late in the year, around about December. Now, if we look at our monthly price change and our monthly price change history, which we'll pull up now, because we change prices once a month, that price, as you know, is changed on the first day of every month. And if you see a history over the last 27 months, you'll see there have been far more decreases than increases over this. Now, given the new environment that we're operating, this has led to what we term short markets and long markets in industry. So what is a short market? The short market comes about really when the market can see that next month the price is going to increase. So with that, a few things start happening. First of all, we find supply starts to shrink, demand increases, and the rebates either remain stable or they drop. In other words, the prices start to increase. And why is this happening? It's happening really because everyone wants to maximize their stock holding, because they want to make stock profits going into the new month. Conversely, when the prices go down, as been predominant over the last 27 months, we have long markets conditions. Now, the long market happens when we see that the price in the following month is going to come down. What happens in a long market? First of all, demand shrinks. What we find is that supply expands dramatically and prices begin to drop. In other words, rebates increase. And this happens because no one wants to hold on to expensive stock and go into a new month with expensive stock when the price is going to drop. So everyone starts to unload their stock holding to minimize the stock losses they're going to incur. And what we've seen definitely in our market is people start to dump. And people start to take a view on whatever the decrease is, and rather not incur the cost of a full decrease. What they'll do is that they will rather incur the cost of a percentage of it. So, for example, if the price we see is going to drop by what we think is 50 cents next month, what you'll find is that people, suppliers, when they start dumping, they'll rather take a hit of 20 cents than 50 cents. It's not first prize, but it's better than the 50 cents. So all of the above starts playing into the markets with regards to stock volatility, and certainly pricing volatility that we've seen. So it's obviously quite important to understand what's happening in the market and have a view on what's happening ahead. And that's that's where, if we move on to the next screen, we are quite fortunate in South Africa that we've got the Central Energy Fund, which on a daily basis, because of the regulations, publishes what is happening in the markets. So because we are operating a month in arrears in terms of our pricing, we are able to check what's happening in the current real market spot prices, and then we can get an indication from that what the prices are going to do next month. Are they going to increase or are they going to decrease? And the principles here are quite simple if you think about it. So what we have is that every month we've got a set price, a wholesale list price, which is set for South Africa, and in this case we can operate on say the wholesale list price in Durban. Now, if you are an importer, as you start importing in the new month, your price has been set at X. However, if the product that you're bringing in, prices climbed internationally, so you are paying X plus. Okay, so the prices that you're landing it at are actually more expensive than what you're recovering in the markets because the price has been set at that in the market. You're deemed to be under recovering against the set price in the market. And the converse works. So if you are then bringing product in and we find that the spot prices in international markets drop, and so the product that you're bringing into the country is coming in at far, far below what the current sort of set price in the country is, you're then landing it at cheaper than the current price, and then you're deemed to be over recovering. So, and what happens during the month is that the daily over and under recoveries are tracked, and that becomes an average, and that average really is then used to deem what the following month's set price is going to be and whether it's going to be increased or decreased. The figures that you are looking at on this table now are the figures from last Thursday, which became available on Friday, and really is the price that is used to calculate what the next month's, or in this case, what tomorrow's price change is going to be. So you can see there on the day that there was an under recovery of over 15 Rand against the set price, and the average for the month is running around about just over 10 Rand 26. If we go on to the next slide, it'll give you an indication of what that looks like if we track it, and I do track it on a daily basis, and there you can see the trend quite clearly. What you have is that we started off the month on the back foot right from the beginning of the month. We were under recovering, and you can see that the daily volatilities and that we've seen, and also the averages, has just been on an up and an up, which has landed us in the situation that we are today. So in essence, what happens is that the market tracks this, the market follows it, and depending if it's going to be an increase or a decrease, the behavior in the market starts to change. And that will eventually manifest itself in either being a short market or a long market for the month. So given all this information that we have on hand and we're able to track, what I'd like to talk to now is sort of what you can do to sort of what strategies or what should you look at in terms of mitigating or sort of controlling this. And coming back to what Marnus said in his initial comments, I mean, fuel is now becoming a strategic decision. There's a saying that goes in industry: fuel doesn't get scarce, it just becomes more expensive. And I think in most run-of-the-mill months that should work. But given what we've experienced, even in terms of that, all bets have been off. So I think fundamentally as a business, you need to make a strategic decision in terms of what is the value of fuel to your business. And, from then on, you need to start making trade-offs. If you view it as being critical to your business, then obviously you need to start looking at your supply side and making sure that you've got molecules. If you don't view it as that strategic to your business, then obviously you're quite happy to play the price game. But unfortunately for businesses, there's no magic recipe in terms of this. Every business is different, and every business is going to have to strike that balance between supply and pricing that will put you in the place that you want to be. So if we look at supply and supply security, supply continuity, I mean, I think there are a few thoughts that I'd like to share with you in terms of that, particularly given what we've experienced this last month. First of all, your supplier base. And there really you have got an option. You can go for a single supplier. The great thing about that is that you can concentrate your volumes with that supplier. You can get maximum benefits from that supplier because all of your volumes sit with them. Obviously, the flip side of that is that with one supplier, you've got increased risk. You can opt for a multiple supply solution. The downside to that, obviously, is that you're diluting your volumes. You're potentially diluting the benefit that you could get from them in terms of pricing. But the upside is that you start spreading your risk so that you know that if one can't supply, the other one can possibly supply. So you're going to have to make a call to yourself and look at your suppliers, look at the depth of their supply chain, and also decide if they've got the depth that makes you feel comfortable with being able to be supplied by them or not. I think an important thing to understand is whoever your supplier is to, they need to look at exactly the same thing. If they got a single supplier or if they got multi-suppliers too. So all along the value chain, these things, we need to start reassessing these things and deciding, does this work for you? Does it give you the security of supply that you want, the comfort or not? The next thing is just the channel that you use for your molecules. There you've got the option of going home base, and obviously home base, you've got the pricing advantage there. It's very convenient. Depending on the size of it, you've got buffer stock that can maybe ride you through sort of price changes. It's also great for stock profits. Now anyone who's got fuel in tank is going to be smiling next month with regards to stock profits. But again, there's a downside to home bases which people don't often look at. I mean, the first thing is obviously the capex considerations. The equipment costs money to put in. It's not cheap. Also, in terms of your cash flow, there's potentially a lot of cash flow being held in stock in the tanks. The management costs does cost to manage whether you want it or not. Shrinkage can become a major concern if that management isn't up to speed. You've got maintenance costs. That equipment needs to be maintained. Something which is not taken into account many times is also insurance costs and cleanup costs that you potentially will have if you have serious spillages and the environmental damage that's a result of that. And again, home bases, you've got a single source there. So once it's finished, it's finished. What are your options after that? Your other option is to look at on-road. The great thing about on-road is that, first of all, there's no capex investment there. So you've got a network, and that's where TFN is particularly strong. You've got a network out there. You've got great management systems. So you've got real-time information to manage your fleet with too. You get immediate response. You can make decisions. There's also a lot of flexibility because there are so many sites out in the network. Often what will happen is that because if you've got a home base, your source of supply is at the home base, your trucks keep on running back to the home base to refuel before they go out again. And if you do the actual costing on those dead kilometers run, it's actually costing you more to come back to your cheaper fuel at your home base than to actually make use of the network and keep your trucks moving. The great thing about a on-road network too is that there's a very wide supply base. So as we've seen during this last month is that we've been particularly good at actually being able to supply our TFN customers because our base is so wide. And, the team has been working exceptionally hard to keep all of our customers appraised of where there are problems with stock and where there is. So that is definitely something to consider. And obviously the other aspect is that there's in normal course of business too, there's no hassles with regards to stock and managing stock. Another way of looking at it is if you've got home bases is look at a combination of the two, and coming back to what I said earlier is that there's no one single recipe, no one single answer for everyone. These are the sort of things you need to start looking at in your business and deciding for yourself what works for you and what fits your risk-taking profile and the value that you attach to fuel in your business. On top of this, if we go to the next slide, in terms of procurement and purchasing your fuel, I think there's a few options that you can have, that you can start looking at now. I alluded Earlier, I alluded to sort of how the markets and the had changed with the more trading environment coming in. And so really what's happened in terms of this is that there's three basic options people can follow now in terms of procurement. I mean, you can, if price is your only focus and you want the best possible price out of there, then you go at spot purchasing. Basically, this is more for your higher risk takers or companies that don't see fuel as being that strategic to their business. And this really allows you to play the market. And I must say it's worked very well over the last 27 months with our predominant price decreases in the market. It's been the optimal strategy for the long markets because there's been an abundance of product out there. The price competition has been pretty fierce. So, that's really played into the hands of spot purchasing. And we've seen a lot of companies focusing on purely on spot purchasing. However, this month is, I think, brought a bit of a reality check, and everyone who's focused purely on spot purchasing has been totally exposed in terms of what's happened here in the market. And many businesses, unfortunately, have found out to their own detriment that, from a longer term, maybe this isn't the optimal strategy to focus on all the time. On the flip side of that, we've got our take or pay purchasing or our committed offtake purchasing. And this is really a safer option if you view fuel as being an integral part and a very strategic part of your business. So, what you want to do there is that you want at all times to safeguard your supply into the market. It's a very good strategy for short markets, and you'll always have your committed volumes at reasonable market prices. But the flip side of it is obviously you potentially are leaving money on the table, that you're not taking advantages of what happens in long markets and the better prices that are to be had out of there. I think a prudent way to look at this is to look at a combination of the two. And really what you need to consider is taking your average volume offtake for the month and then splitting it, taking a percentage of that and say, look here, X percentage of my product I'm going to be looking to purchase on the spot market, and the balance, what I'll do is I will lock it in on a commitment, and I'll know that is safeguarded. And given the information that I shared with you earlier in terms of the way we are able to check pricing in the market, you'll see very early in the month whether this is going to be a short market or a long market. So what strategy will you then follow in a short market? In a short market, what you'll know is that prices are going to rise, products are going to become short at the end of the month. So what you do is that whatever your spot allocation is, you'll buy that at the beginning of the month. You'll concentrate on moving your spot allocation. Your committed take or pay allocation you'll keep to the end of the month, where when basically you'll have that to ride out the potential shortages and the price increases. The flip side you'll do when the markets are long. When the markets are long and we see that we're going to be moving to a price decrease scenario, what you'll do there is that you will hang on to you'll move your committed volumes first to get that out the way, and then basically it'll leave you with once your committed volumes are out the way, you can play the market at the end of the month with regards to your spot prices and take advantage of any good spot deals that there are in the market. However, I must stress that obviously in terms of this, it's up to every company to decide where that split is going to be and what are they comfortable with in terms of that. Within the TFN group, we've got our fuel desk option, which we make available to our customers, and that really is what we're talking about here. It gives everyone the benefit to lock in volumes at good commercial prices, but at the same time allow you to partake in the upside when there are good spot prices available to be had. Then the third option, which is really purpose made for when you've got very defined contracts, be it a construction project or a contract to move product over a limited time frame from one area to the next, and you've got a good idea of what your volume requirement is. What this allows you then is to lock in prices and lock in supply for a specific time, and that's maintained during the duration of the contract. And that'll obviously, just irrespective of whether prices go up or down in the market, whatever price that you've tendered with it for that particular contract, that's locked in, and you don't have to worry about fluctuations in the market. So that's me. I hope in terms of the questions that got posed before this answers as many of those questions as possible. But please, if there are more, let us know them. I hope this has been informative and just giving you a bit more food for thought in terms of your fuel procurement and how you view it, and what to do going forward in this market, which is, I think we'll all agree, is ever changing.
Thank you, Greg. Wow, I think you must be out of breath, because I think the rest of us are. That was a lot to process. I think the word that stood out for me throughout this presentation was the word risk. And I think for me, that was the key takeaway. Understanding the fuel market is no longer just about price, it's about managing your risk. Right, so with that in mind, let's get into some questions. Did you grab a sip of water there, Greg? Are we ready? I think the first question was kind of more posed to our marketing team, which was, will these slides be available? And the answer there is yes. A recording of this session will be made available. Please just keep an eye out for our social media pages, and especially our LinkedIn page. Right, Greg, to you. Do you think the government will intervene if prices rise too sharply? And that didn't come from me, but I had the same question.
Okay, and I think that's the frustration that everyone's sitting with at the moment. In terms of the pricing mechanism, we have got a facility there called the slate levy, which is basically an extra charge the government imposes to balance out swings and roundabouts. I mean, we really don't understand, as things stand, and the price changes tonight at 12 o'clock. By the time we went into this meeting, we've had no real indication from government what's going to happen with the slate levy. And again, unconfirmed sources are saying in the slate account, there's considerable funds sitting in the slate account. We don't know if they're going to use that to buff out any, if it is available, buff out any of the potential price increase. We've had in the past where when the increase was particularly large, that the government would maybe split over 2 months. I just think that unfortunately is done on the back of the suppliers' balance sheets. They have to carry the risk and the cost of that. The government doesn't. So I think this current increase that we're seeing, or potential increase, is of such a nature and so huge. I don't think sort of anyone who supplies product into the country has got the finances to be able to carry that for an extended period. So, the short answer to this is, as things stand, it's anyone's guess. We'll have to wait until we get the notification from government to see which way this thing is going to go.
Thank you, Greg. I think in sticking to the price increase expected tomorrow, there's a question here that says, what is the expected scenario on the 1st of April? Are we likely to see higher prices with improved supply, or higher prices with continued constraints?
Look, I think it's, if the experience that we've had in the import side is that, importers are planning a month in advance. So, a ship just doesn't arrive, in our waters to unload. There's an extended planning period that goes before that. So, all indications that we're getting from industry is that that planning period has taken place. The ships have arrived. There is stock in tank. I mean, there's a lot of heat out in industry there saying, there's price gouging taking place, and why don't they release that stock? But I think, if you listen carefully to my talk earlier, is that the product that's landed is landed to be priced for the new month. So yes, there may be stock in tank at the moment, but in terms of the supply dynamics of getting it into stock, it's not going to be at this month's prices. It has been priced for next month. So all indications are that next month, we will see stock becoming available again quite freely. And I think whatever the final regulated price change is, that's going to be put in against this current month's wholesale list prices. However, as I've alluded to in my talk as well, I think the rebates that we've been seeing, running into the R1 pluses, and, even higher than that if it's a long market towards the end of the month. I think we're going to see in the short term a drastic change to that. Where that number is going to be, I mean, it's anyone's guess. I think we'll have to see what comes out in the washing tomorrow. But I think in the short term, our expectations of having, open tap supply at the rebates that we're used to, I think that's not going to happen.
I think, Greg, maybe it's a similar question, just asking you to take out your crystal ball and just polish it up for us and have a look in the next 4 to 8 weeks, which is a projection into May, maybe take it to June. From your vantage point, what do you suspect is going to happen as far as fuel supply is concerned?
Well, I think the critical thing there, Marnus, is obviously it all revolves around how quickly the straits can be opened. What we've had in the last weeks, the market is watching very closely. When you've had announcements by Donald Trump that negotiations have been taking place with the Iranians, immediately what we see is that crude prices dropped by 12%. So I think the market is poised to have quite a quick adjustment if we can get the flow of oil back again. I think there's a lot of oil in storage. So, if we can get that flowing, as soon as the straits are opened, it's going to be, anything from 4 weeks to a month and a bit, that oil is going to be out. During that time, I think what you'll see is that you'll see the refinery starting to fire up again and get production going. So, again, the crystal ball or the trick question here is what's going to happen with the straits. I think as soon as the straits are opened, we're going to see the markets adjust back to reality or where it was pretty quickly. I mean, I talk maybe a 2, maximum a 3-month process in terms of doing that. Obviously, if this becomes a protracted war and the straits are closed for much longer, not only for sort of energy security in the world, but things like your industrial feedstock security, things like food security with the fertilizer and that situation, I think things can become a lot more critical.
Right, Greg, and what I did was I just split that question into 2 parts. That was the first part of the question. The second part of the question that somebody asked was specifically looking at the TFN network in South Africa. Which corridors or provinces do we suspect is going to be mostly hit by risk or stockouts?
Okay, I mean, Marnus, that's very difficult to say because, the thing is that the beauty about the network is that because there's a diverse sort of supply going into that from various sources, is, there's no one particular place that gets hit at once. What we've seen over the last month is that we've seen sort of even in areas where we've had relative shortages, we've had some depots starting to ration, other depots stock out. In that same area, we've had a few depots that have got or supply points that have been pretty strong, for a while because they're generally operating on committed volumes. Their volumes are in place. So I think coming back to sort of the strategies that we talked about earlier, I think what we've seen is that people that are relying on spot prices, that are looking for premium prices or best prices to go into the network, they've potentially been caught short towards the end of the month, in a short month with regards to both pricing and supply, while suppliers that have had committed volumes, they've gone the distance and those volumes are been locked into their supply arrangements. So they've been able to ride out the shortages and sort of carry through in terms of supplies, particularly to our TFN customers, sort of late into the month, if not almost all the way through the month. So, a particular thing that we have seen in the network is volume spikes where people have actually used us as the buffer against short supply for them in terms of their home bases and other suppliers. So, it's been great for us to provide that service to our client base, but at the same time, obviously, it's been a bit of a double-edged sword that, as our volumes have been increased with a spike in demand, we've had to work very hard in terms of replenishing that, and a lot of times it's come at an additional cost, unfortunately.
Great, thank you, Greg. I think you did cover this in your presentation, but respect for the question being asked, maybe you can just touch on a few of the points that you did mention. So the question is regarding to what extent are the current diesel shortage in South Africa being driven by international geopolitics versus local constraints such as refinery outages, import logistics, or port capacity? And which of these do you think is currently the biggest pressure point?
Okay, I think it's, if I can have an almost a cop-out answer to that, is it's a bit of everything. We have got our challenges locally, but I think certainly, the supply shock that we've had in the last month has sort of driven all of this and has exacerbated and almost highlighted the deficiencies or the potential deficiencies that we've had in our current, in our current market environment. So, look, it's been a real combination of everything. I think really the shock of the supply shock has been the predominant driver here, but it has been exacerbated locally in terms of what's happened in our local conditions. There's no doubt about that.
Yeah, I think I totally concur. I think well answered, and I think that is not just a cop-out. I think you summed it up perfectly. A question just popped in. I have read that India has placed a tax on all refined product export. This will have a direct impact on our pump price, and we will probably see that in maize price. Do we have other purchase options in terms of refined supply?
Look, yeah, I think we do get quite a lot of our product from the east. Information in terms of exactly where it comes from is pretty scant. So I'm not too sure, and I would, in terms of the potential impact that would have. But I think what you will be seeing, in the next, in this scenario is countries, particularly the likes of India, that have got a huge offtake, that have been put under a lot of pressure. They've obviously having to source your product in other places at much higher prices. I think you'll see countries moved and refineries moved to actually protecting their own interests, and they're going to have to recoup costs somehow. How that will eventually translate into what we see at our pumps, I wouldn't be able to tell you this, but coming back to what I said earlier in terms of importers and sort of their price build-up that's not covered or not catered for currently in terms of our regulatory price build-up, I think you're going to see a serious adjustment to the rebates we see in the market, and that's just the realistic way in which people bringing product into the country have to recover additional costs that aren't catered for in the pricing mechanism.
I think something directed at the TFN. The question is, in a constrained supply environment, how does TFN prioritize access to diesel across its client base? Are there allocation systems, volume caps, preferred clients, and how can transporters secure priority access?
I think in terms of that, I mean, and anyone who's dealt with us over the last month will attest, is that we, first of all, we don't have preferred customers that are allowed to go to a depot and other customers aren't. I think what we have tried through this last month to the best of our ability is keep the taps open across the widest possible network that we could. What we've had to do in certain cases is to give everyone a fair bite of the cherry, is to institute transaction limits which really, if you went in there and you used to getting a 400-liter transaction, and now all of a sudden you could only get a 300-liter or 200-liter cap on your transaction. That's really a way that we wanted to try and be fair to everyone, give everyone a bite at the cherry, and just keep everyone moving. In the same vein, there were some quite significant price changes throughout the network. What I know that we did is that we operated on an average weighted pricing too. So, what we did is that we cross-subsidized between sites and between different supply options as and when we could get there, to try and give everyone as competitive pricing as we could across the entire network. So, I think it's the feedback that we've got from our customers has been exceptional. I mean, the feedback that I've had sitting in front of customers, it has really worked for people. Can we improve? Sure. I think there's always place for improvement, and what's been quite good is going through something like this is that it always highlights deficiencies in your system, and I think we can assure everyone out there that we're going to be working extremely hard to that if this ever happens again, is that the few points, niggly points that we did have, that we'll have ironed them out, and that will be a much better experience next time round.
Our last question, Greg. I want to just blend two questions in one. The one question was, what should guide me when choosing a fuel supplier? And then just on that, I think this question adds to it. What specific actions should fleet operators implement immediately to protect operations, such as route adjustments, depot selection strategies, bulk storage, pre-buy deals, and how can the TFN platform be used to reduce exposure to stockouts?
Okay, I think, and unfortunately, I'd love to have Grandma's recipe, which I could give you, which would, make everything go away. But I alluded to a lot of things in my talk that I think companies need to start looking at. And I think, the fundamental question that everyone needs to have now, especially going through what we've done, is how do I view fuel? If it is a strategic purchase, if you've seen the importance of it in your business, then you need to start safeguarding yourself with regard to your suppliers, in terms of making sure that you move more into a committed type strategy with them, that you make sure that if there are supply shocks, that you at least have got that buffer in place. Again, without rehashing my presentation, I think there's a broad scope of things that you need to look at, but anything that can potentially reduce your risk, I think you need to have a serious look at that. But understanding that with that risk reduction does come at a cost. But at the end, I think the ultimate sort of question that you need to ask yourself is, what is the cost of the fuel and having fuel versus standing dry and my operation standing still? That's really the bottom line when it comes to this.
Greg, that concludes the questions and answer section. Is there anything you would like to leave our audience with before we wrap it up?
No, I just think from my side, if there are questions, please, or if there's anything that you need, please feel free to contact us. We're here to serve you. I think we've proven ourselves in the market over the, since we first entered the market, that we are exceptionally customer focused. From us, it's all about getting your wheels rolling and making sure that your trucks move across the forecourts. So if anything that we can help with, we're here to serve you. Please contact us, and we'll do our very best to put our best foot forward and make your operation run as efficiently as it possibly can.
Thank you, Greg. And I think the takeaway for me today is that fuel is no longer just a procurement decision, it's a strategic one. And
Yes.
Ultimately, the question is simple. Are you buying fuel, or are you managing your fuel strategically as an asset? And when choosing a fuel supplier, you need to ask yourself questions. Are they flexible across channels? And importantly, do they offer data and insights needed to make better decisions? So thank you for that. And a special thanks to our marketing team working behind the scenes to make all of this possible. And The businesses that win in this environment won't be the ones that buy fuel cheapest, but it will be the ones that manage it the smartest. Thank you for your time. From myself and Greg and the whole TFN team, goodbye.
Thank you.